What's up YouTube? Nicholas Daniel with Flying Vulture Capital, and I'm going to explain my favorite trading strategy, my most high probability of profit one, the Iron Condor. So let's begin. What is an Iron Condor? To understand this, we've got to dive into options. First and foremost, you have calls and puts. A call contract will go up as the market goes up. A put contract will go up as the market goes down. So a put is synthetically shorting the market. A call is synthetically longing the market. One thing to consider about options though is you can long and short options themselves, right? If you short a call, meaning you sold a call, you actually make money as the market goes down. If you short a put, you actually make money as the market goes up. Another advantage to shorting an option is you have theta decay. As time goes on, options out of the money decrease in value, right? When you buy an option, you might see this. You buy a call, your call price doesn't hit, and the option starts going down even though the market trades flat. This is because as time increases, the likelihood that that event will occur decreases. So when you are an option seller, you make money as time goes on. An Iron Condor takes advantage of both buying and selling options simultaneously. What does this mean? Pretty much, if you sold a more expensive call, you bought a less expensive call, what you'll see is a net credit, right? For instance, if you sold a $80 call, it was worth $80, and you bought a $70 call, you'd make $10 net credit. Same with the put side. On an Iron Condor, what we're gonna do is set up a trade where we're selling a more expensive call, a more expensive put, and you're buying the less expensive. Now, going back to the idea of theta decay, what we're gonna take advantage of is the market trading within this range, within the short call and the short put over a period of time and making money by the contracts simply losing cash. Now let me show you how to set up a trade. Now, I'm pulling up Tasty Trade. I'm not sponsored by them, but they're an excellent options brokerage. Let's say that I see that 5100 on the SPX is gonna act as support, and I believe that 5200, for whatever reason, is gonna act as resistance. What I could do here is I could pull up the options chain. Let's just do 5 days out, hypothetically. I could sell the 5200 call, meaning I don't think it's gonna go above 5200, and I could buy any call less expensive. I'm gonna do the 5205, but it doesn't matter. It just changes your risk reward. Now I can do the same for the bottom side. I sell the 5100 put, I buy a less expensive put. And you can see here I entered a position with a probability of profit roughly around 60%, a max profit at $185, and a max loss at $315. This is an excellent trade because you're not risking too much capital to make your returns. Personally for me, when I set up a trade, I look for 80% probability of profit. So if I were to set up this trade and execute it, I would drag the positions out a bit further on either side and get somewhere roughly in the 70-80% right here. Perfect. Now you can see here I'm risking $415 for $85. Let's explain risk reward and what it means for an Iron Condor. Now, the trades I usually execute are 80% probability of profit trades, risking roughly $4,000 for about $1,500 gain. What this means is if we executed the trade 5 times, 4 of the trades would be a winner, 1 of the trades would be a loser. Now, if you only did 5 trades, you might see 5 winners, you might see 3 losers, but if you do it over time, over a month-to-month and a year-to-year basis, the statistics and probabilities will add up. So going to my example, if I execute 4 of the trades to be success, 4 times 1.5 is $6,000. But that one trade will occur, the one that goes against me, and I lose $4,000. Well, 6 minus 4 is $2,000, and in 5 trades, I made $2,000, which is an excellent profit for the day. Now, let's go on to talk about how do you manage this risk reward and how do you manage the Condor itself, right? One thing I like to do, let's cut back to Tasty Trade, is when I was an early trader, I would set up a very high probability of profit trades in the 90s. And I thought it was free cash, right? Look at this. 94% probability of profit. Seems like legitimately free cash. Let me move this out as options chain has it updated. And it looks like here, free $20, 95% chance. Being a young trader, I would execute these trades almost every day and watch my account grow. The problem is Events where these prices will be triggered within a day or within a week will occur, and your portfolio is not ready. If you have a lot of your portfolio riding on a small gain, eventually something will strike, either a bad piece of news, the Fed will speak, and those short or long side, either the call or put side, will get caught in the money, and you'll end up losing a lot of capital. That's why I again say 80% probability of profit is king on an Iron Condor. Now, let's talk about when the market starts to go against you. Now, I'll pull up my chart, and let's say the market's trading within a range, but we get a bad piece of news and the market starts to go down. Let's go back to that hypothetical 5200, 5100 Condor. What I would do within this position, if the market went down, I would close this side, pretty much clear that out, and I would keep this side alive. Now you see here, I still have profit on the winner, the call side, and I'd let that play out for max profit. And even though I didn't make as much money as the Condor could, I still ended up a winner on a trade which could be a loser. The important thing to understand with a Condor is only keep it alive when the market's trading flat. If you get any indication, either news or technicals, to say it's going to trade to one side, close the position. Now, that's all my content for today. I'm starting off my series where I'm talking about trading strategies. Hopefully you guys enjoyed, and remember, statistics and probability is greater than emotions and fear. Enjoy it. Please like, subscribe, and share.